Let's say you could snag a cool 5% on a short-term bond, GIC, or cash product. Sounds like a slam dunk, right? Well, it might sound like a great deal, but there are some hidden risks that you might not know about, ones that could be putting your retirement goals in jeopardy. So let's find out what's lurking just beneath the surface and what you can do about it. You're watching Inside Investing. Hello, everyone, and welcome to Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Rob Moise, and joining us today is Ben Felix, Head of Research and Portfolio Manager at PWL Capital. Now, you may know Ben from the Rational Reminder podcast that he co-hosts, or his YouTube channel with more than 300,000 subscribers. Ben digs into the research, he teases out those insights for us, and he fills investors in on all things investing that you need to know about. So, Ben, we really appreciate you coming back on the show. It's always great to have you here.
I'm happy to be here. Thanks for the invite.
Always curious, Ben, where do you get some of the ideas for the fantastic videos that you do that seemingly tease out these insights deep in these research papers? Where do you find this stuff? What's your process here?
Oh, geez. Well, this topic that we're talking about, I did some research that I made into a video on cash because interest rates on high interest savings accounts were at 5%. And so we at PWL were getting a lot of questions from clients. Should I be moving my long-term investments into cash to get the 5% yield? That's where that one came from. And then the long-term asset allocation stuff that we're going to talk about later in this discussion, that's kind of a cool story, actually. So one of the co-authors had been a guest on our podcast. He did a really popular episode with us on some of his other research. And as soon as they published a new paper that we'll talk about later, he sent it to me by email and said, "Hey, Ben, you should check out our new paper." So that's one of the neat things about building connections with people that are in academia through our podcast, is that when they have new research out, they'll sometimes give us the heads up.
Awesome. Yeah, I was picturing you with a nightstand stacked high with like 100 research papers that's like your bedtime reading or something like that. But it sounds like it's not quite that intensive, right? You have stuff coming to you now at this point, right?
Well, for that one, but it is also true that because our podcast focuses on largely interviewing people in academic finance, for each episode, I'll read, depending on the person, anywhere from 5 to 15 academic papers that the guest has authored or co-authored. And so that gives me a lot of exposure to really interesting different research ideas. Another thing that happens when you read a lot of academic papers to ask the researchers about their work, you get exposure to a lot of research.
Well, it's fantastic stuff. I know your viewers really appreciate the insights you bring, judging by the comments on a lot of your videos. And you did mention that you had done some videos on these hidden risks that we're going to talk about. But before we kind of get into that, what do you think is driving the popularity of bonds, GICs, cash products? Like, these things had been so unloved for years and years and years. What's behind this newfound popularity?
I think the big thing that changed is that nominal yields and real yields, nominal meaning without adjusting for inflation and real being adjusted for inflation, they've gone up. They're higher now than they were, 4 years ago. But I think that the nominal yields of fixed income investments, and in some cases cash investments, being around 5%, I think that's a number that a lot of people find attractive. I don't really have specific evidence to back that up, but I just, from talking to people, when yields hit 5%, everyone's like, wow, 5% that I can get with no risk or low risk. I think that really flipped a switch in a lot of people's minds.
I definitely think that, after seeing these rates be so low for so long, that it's almost like the surprise factor. Well, like, wow, this must be a phenomenal deal. I've never seen anything like this before. Of course, it's happened, years ago in the past, but certainly not something that we've seen recently. So I imagine then there's some misconceptions, obviously, that people might have about just like how bonds work and GICs work and stuff like that. That's kind of driving that interest. I know we're going to get into some of the hidden risks, but do you think that there's some major misconceptions that people have just about bonds, GICs, cash products in general?
Yeah, the big one, and you alluded to it just now, and we'll definitely get into more detail throughout the discussion. But the big one is that bonds and cash are safe investments, full stop. That is their reputation. I mean, even in financial theoretical research, the risk-free asset is often referred to as the 30-day treasury bill. But I think that safety in an investment really depends on who the investor is and what they're trying to achieve. So in a lot of cases, something that's generally considered safe, like cash or like a bond or a treasury bill, can actually be quite risky for investors in some situations.
Yeah, and we're going to get into all that. So, really looking forward to diving into our conversation here. And I think first off, and you just alluded to it there, what risk is depends on what your investing goals are. So, generally speaking, what is a long term investor trying to get out of their portfolio?
Yeah. So I think, like you said, risk is different for a long-term investor relative to a short-term investor. And when you think about what does a long-term investor want to achieve, they want to achieve their future consumption goals. Like they want to be able to use their investments in the future to fund their retirement. So the big risk for a long-term investor is that their investments don't end up earning enough of a real return, a return adjusted for inflation, to meet their future spending goals, their future consumption goals. That's very different from a short-term investor. Their main risk really is volatility. If a short-term investor wants to buy groceries tomorrow and they have $100 in their bank account, they don't want that $100 to turn into $80 between today and tomorrow. But a long-term investor, they tend to have the benefit of time on their side. And I think that this is true both for people who are accumulating for retirement, people who are saving and adding more money to their portfolio. I also think it's true for people who are retired, because retirees are not spending their whole portfolio tomorrow. They're spending 3%, maybe 4% per year of their portfolio. So even if things do decline, if you're not spending very much from your portfolio, I would still say that you have a long time horizon. A longer term investor who can withstand volatility can invest in riskier assets like stocks, as opposed to traditionally safer assets like bonds and cash. One thing, though, that I think is important to point out is that volatility is a major psychological and behavioral risk at any time horizon. Because even if you have a 30-year or 40-year time horizon, that doesn't mean volatility is not going to make you feel sad. Nobody likes to see their investments drop by 20 or 30%, even if it's not going to be detrimental to them in the long run.
Right. Ultimately, we are real people here. You have to be able to live with your portfolio, and that includes the ups and downs of it. So it's one thing to say you can look through volatility as a long term investor because it doesn't matter until it really starts to matter to you down
Yeah.
in your gut, right?
Yeah.
So you spoke about this too, this idea that long-term investors can kind of ride out the volatility. So for a long-term investor, then take us through some of those hidden risks about a bond, a GIC, a cash product, what have you, that they might not be taking into consideration here.
Yeah. So let's think about GICs for a second, because I think this is a big one. GICs aren't priced because these are contracts that you enter into with a bank or a credit union or whatever, but they don't trade. They're not priced. They're not priced because they don't trade. So you put $10,000 into a GIC, no matter what happens in the market between then and when you get your principal back, the $10,000 is going to show in your account. It's not going to go up or down in value. But just like a bond, a GIC's economic value changes as interest rates change. So if interest rates go up, bond prices are going to go down. GIC prices are not going to go down, but their economic value is still going to go down because you're going to continue receiving the same interest rate when you could be getting a higher rate in the market by buying a new GIC or a bond. So I think that the lack of volatility in GICs creates a bit of a veil of safety that isn't really there. So that's one piece. But then the other piece is that with a GIC, you know what you're going to get in nominal terms, but the real return on a GIC, and this is a theme that's going to come up again and again as we talk about these typically referred to as safe assets, the real return on GICs is going to be a lot lower than stocks, for example. Historically, you've been much more likely to lose money in that type of investment in real terms as a long-term investor. That's GICs. Now, cash in particular is an interesting one. It is the shortest duration asset. Duration is like, I guess, how far into the future the cash flows are. The result of that is that cash is a really poor hedge against falling expected returns. And I will unpack that because I know that was pretty jargony. It basically means that if interest rates fall, your cash does not change in value. But if we think about other financial assets with longer duration cash flows like bonds or stocks, When interest rates fall, their values typically increase. When discount rates go down, prices go up. Now, why does that matter? If you're a long-term investor, you care about future investment opportunities. So you're earning 5% on your cash today. Cool. Imagine you go and build your financial plan on a 5% nominal return from your cash. So you've planned out your savings and your retirement spending and all that kind of stuff. And then interest rates drop to 3%. You're toast. Your whole financial plan just got completely blown up. So that's not great. In the case of stocks or bonds, when that happens, when market interest rates fall, your financial plan doesn't necessarily get blown up because the value of your financial assets will tend to increase. Like bonds, mechanically, when rates go down, their prices go up. That is what we would call somewhat of a hedge against the risk of falling expected returns in the market. So cash doesn't have that. You're completely exposed to the risk of changing, falling expected returns in the market. So that's one piece. Another piece on cash is that we talked about GICs losing purchasing power to inflation. Cash is even worse for that. And then more generally, cash has historically had much lower real returns than stocks and bonds. Yeah. So I think that the inflation piece, the impact of inflation is like, it is the risk that long-term investors need to worry about. It erodes your purchasing power over time. So if you have your money will be able to buy you less stuff in the future, and GICs and cash tend to be much more exposed to that risk than stocks.
Right. So what I'm hearing is you can't just stuff all your money under your mattress beside your shotgun and call it a day. That's not the financial plan that most long-term investors are after here.
Well, beside the shotgun under the mattress is even worse. At least with that's a good point though. When I'm referring to cash, I'm referring to high interest savings accounts or like 30-day treasury bills. So you're earning some yield on cash when I say cash. If it's under your mattress, you're not. That's much worse. Your real returns on mattress cash are even worse than on high interest savings account cash.
But what about on the bond side of things? Because I think people will look at bonds and say, bonds offer a greater return. So are they not a good deal? Like, what is it that makes them a hidden risk, basically?
It's two things. One is that they've historically lost purchasing power more frequently than stocks. So that risk is still there. Bonds are better than cash from that perspective. So you've been much more likely to lose purchasing power in cash than in bonds as a long-term investor historically. So bonds are a little bit better, but they're still exposed to a lot of risk, a lot of inflation risk. If inflation increases, your real bond returns can really get hammered hard. And I mean, this happened in Canada in very recent history, where real bond returns were meaningfully negative. People saw the nominal negative bond returns and thought, ouch, that really hurt. I wasn't expecting that from my bonds, but most people didn't pay attention to the real bond returns, which were like historically negative. One of the things that's interesting about this is that in the data on historical stock and bond returns, stocks tend to have a little bit of mean reversion, where after really good returns, future stock returns tend to be a bit lower. After really bad returns, so there's a market crash, future stock returns tend to be a little bit higher. Bonds, in real terms, bonds kind of have the opposite, where if real bond returns have been meaningfully negative, that meaningfully negative return will tend to be more persistent. And that's because inflation tends to be persistent. So if you lose a bunch of money in your bonds because of high inflation, you don't tend to have mean reversion where your bond returns all of a sudden bounce back. You tend to have persistently high inflation, which keeps eroding the purchasing power of bonds. So again, that's something that matters more for a long-term investor than for a short-term investor. But I think it really does matter.
Now, a skeptic might say, well, all financial assets are affected by inflation, right? You can't escape inflation. It's the bane of the investor's existence, right? So why is it that stocks then offer a meaningfully higher return potential, real return potential, I should say, than something like bonds?
So all financial assets produce expected future cash flows, and how much you will buy them for, how much you'll buy those cash flows for today, depends on how risky those future cash flows are. So it's a pretty financy explanation. But the way that those differences get represented is through something called the discount rate. How heavily are you going to discount those future cash flows from the financial asset? Riskier assets like stocks will have a higher discount rate applied to their expected future cash flows. That means you're paying less for the future cash flows, which means you expect to earn a higher return if you actually receive those cash flows as expected. And then bonds have a lower discount rate, a lower expected return, and cash even less so. And when you think about it from the perspective of a stock investor, stocks are fully exposed to a company's ups and downs, including the potential for total losses. So that's basically why they carry a higher risk premium. But we got that question so many times. Why don't I just get out of stocks because stocks have been doing poorly recently and get into cash? And part of the answer is that, well, risk premiums have been positive in all interest rate environments historically. So that's probably what we should expect in the future.
Now, again, I'm going to play devil's advocate here again. What about when stocks are, let's say, really overvalued, or at least there's a perception that they're overvalued in the market? Would it not make some sense then to pivot to something like bonds or GICs or cash products, what have you?
We did have a guest on the Rational Reminder podcast. I can't remember when it was, later last year in 2023, and Victor Hagani and James White. There were two guys that came on. And one of the takeaways that they had from all of the work that they did is that it actually can make sense to switch between stocks and real return bonds, specifically, not nominal bonds, depending on the relative expected returns of stocks and real return bonds. So their research suggests that maybe you should be flip-flopping. Practically, though, I think it's really tough. I mean, knowing what the expected return on stocks are, which you need to know to implement the theory that they're talking about, is really hard. We have some metrics like the Shiller cyclically adjusted price earnings ratio, which give us a little bit of information about differences in expected returns with respect to stock valuations. But it is a very, very noisy relationship. And I also think that just practically, if you go and tell someone, here's a decision rule to switch between stocks and real return bonds based on their relative expected returns, and here's the formula you need to calculate their expected return, no one's going to go and do that successfully. Even if I said, yeah, I love the theory, but more practically, I do still think market timing is really hard. I also think that the discipline required to do something like that, even if we said we like the theory, is really hard. And there's also tax implications. Like if you're constantly flip-flopping between stocks and bonds, it's potentially can be very expensive if you're a taxable investor. So, and also, like, we don't know when are stocks overvalued. Tell me when stocks are overvalued, and I'll tell you when we should change our asset allocations. But I don't think we have that much information about expected returns.
Of course, the other aspect to this too comes back to the emotional piece of investors, right? I mean, even if you knew the theory, even if you were pretty confident in it, could you stomach the actual risk involved in making those switches? It's a tough thing. Now, we've talked a little bit about, the theory here behind some of these things. I'm going to throw a little bit more theory out there too, or theoretical, hypothetical kind of situations here. What about this idea? And we've heard little pockets of grumbling about this, but deflation. Okay, let's say we're in a deflationary environment. Does this flip everything on its head, and now bonds and GICs and cash, these are like my best friends, or what's the deal there?
Well, yeah, it does actually. Can we use that information? Probably not. Tell me when we're going to have deflation, and I'll tell you when to I'll tell you when to change your asset allocation. I don't think that we can predict that. If you could, with perfect foresight, sure, you would switch into bonds, I guess, at least if you believe that the historical data are going to be similar to what happens in the future. But I don't think that anybody, I mean, I was going to say most people to hedge the statement a little bit, but I don't even think it needs hedging. I don't think anybody can predict accurately future extreme deflation.
So then put it on a scale for us from a long-term investor's perspective. And if I'm talking stocks, I'm talking bonds, GICs, other cash products and stuff like that, put it on a risk scale for me in terms of, and risk being defined as reaching my long-term goals, be it retirement or what have you.
That research has been done both from the perspective of what you just said, meeting future consumption goals. It's also been done from the perspective of future purchasing power. So which asset is riskiest from the perspective of losing purchasing power over the long run? It's two separate research papers on the same data set have asked those two different questions. On both accounts, in both papers, cash tends to be riskier than bonds. which tend to be riskier than stocks for long-term investors. So one of those, the purchasing power paper, is looking at 30-year horizons. The probability of losing money in stocks is much lower than it is for bonds and cash. And then for another paper looks at an investor's life cycle, where they're looking at a longer period. I think it's probably a 60-year on average simulation that they ran. And again, over that full life cycle, they found that if you were investing in cash the whole time, you had to save way more and had a much higher probability of running out of money and using cash. And then bonds a little bit less so, and then stocks in that simulation much safer.
So if you were to invest in a real return bond on the riskiness scale that we just talked about, I guess they would fit between nominal bonds and stocks in terms of riskiness. Is that fair to say?
Yeah. So it's, if you precisely duration match your real return bond to your time horizon for needing the money, real return bonds are theoretically risk-free. Because if you know you need the amount, say whatever, $1 million or $500,000 in 10 years, and you buy a 10-year real return bond, you know exactly what you're going to have in real terms after 10 years. That's risk-free. The problem is knowing that exact time horizon.
The listeners here are going to think to themselves, okay, I totally follow what you're saying here, Ben. This is all like really great stuff. But what does it mean for my portfolio and the asset allocation that I should be adopting if I'm a long-term investor and I want to try to reach those long-term goals that I have? Is there such a thing as an optimal portfolio construction here that kind of, for a long-term investor, weighs the risks and returns and threads that needle? What does the research say about that?
Yeah, so optimal is really tricky in finance because anytime you want to run an optimization, it requires inputs, and the inputs are always about the future. What are stock returns going to be in the future? What are bond returns going to be in the future? And we don't know. We don't know what those numbers are. Your question is still valid because you can optimize within a specific data set. So that has been done in a fairly new paper. It's a not peer-reviewed paper yet. It's a working paper from some good quality academics, though, who have lots of other published research. They took this massive data set. It runs from 1890 to 2019. It includes 38 developed market countries. And I think it's like 2,500 country months of return data points. And what they do is they take that big database of returns. Oh, and it's for stocks, bonds, and bills, I should mention. So what they're doing is they're pulling a block of stock returns, for example. On average, they're pulling 10-year blocks. And then they pull another block, which is going to come from a different country in a different time period, randomly selected. And they're going to stick that onto the first block. And they do this to create these simulated return scenarios. And they do 1 million simulations in their paper. And they use that data set and that simulation technique to model an American couple who save 10% of their income for 40 years and retire at age 65. And then they start drawing down their portfolio and collecting Social Security. With those countries over those time periods, with that sampling method, they find that 35% domestic stocks and 65% international stocks produces the best outcomes over the entire life cycle for this hypothetical American couple. No bonds, no increasing bond allocation over time. And this is the asset allocation for accumulation and also for retirement. So this hypothetical couple is happiest with their retirement outcome on average. And in the worst cases, actually, that's important. It's not just the average outcome that was best. The worst case scenarios were also better than any specifications that included bonds. So yeah, I mean, that was a surprising finding. One downside of this all stock allocation is that the average drawdowns were much larger. So it's a more volatile portfolio. This thing's losing money in real terms at a much greater magnitude than the portfolios with bonds. But the important part is that the actual risk of running out of money in retirement was lower for the all stock portfolio, which, as we talked about earlier, is volatility really the risk that long-term investors should care about, or is it the risk of meeting their future consumption goals? I would say it's the risk of not meeting their future consumption goals, which in this research stocks did a better job protecting from.
You were not trying to totally beat up on bonds here, right? I mean, like all this makes stocks sound pretty awesome, but of course, there is that volatility risk. So I'm curious, like, what do you think about some of these conventional rules of thumb and traditional wisdom that we hear in the investing space, where you want to kind of glide more towards bonds as you age, and you need to kind of preserve your capital, and maybe you're not as comfortable with portfolio volatility in the same way you might have been earlier in life. Do those still hold in your mind to some extent, or do they need to be challenged?
I think that is worth questioning. And the idea that people should increase their bond allocation over their life cycle, I think that is worth calling into question, not just based on this paper, but based on other research as well. So yeah, I mean, if someone asked me, should I follow a rule of thumb glide path for my asset allocation, I would probably say no, honestly. Like, a lot of this research has been done on target date funds because they mechanically follow these asset allocations. In Canada, we're actually lucky, at least lucky based on the research that I'm thinking about now, in that we don't have a ton of target date funds, but we have a lot of fixed asset allocation funds. Like, you can get a 80-20, 80% stock, 20% bond ETF that gives you a globally diversified portfolio of stocks and bonds that doesn't follow a glide path. And I think that's, based on a lot of the research, is probably better than the typical target date fund glide path. And yeah, I think another thing that often gets missed in thinking about life cycle asset allocation is other income sources. Like, a lot of retirees might work a bit in retirement. That can change your asset allocation. They might have pensions. Everyone has a pension. I mentioned CPP earlier. Everyone in Canada, not everyone, a lot of people in Canada have some combination of GIS, Guaranteed Income Supplement, Old Age Security, OAS, and Canada Pension Plan, CPP, forming at least a component of the retirement income. And CPP is expanding, like it'll be an increasing component over the next 40 or so years. So even if someone hears me mention pensions and say, well, I don't have a pension, there's a good chance you actually do. And that can similarly affect your asset allocation.
Right. You can make the argument that these support programs are bond proxies of a sort, right? That could, if you were comfortable with it, allow you to maintain a higher stock exposure for a longer period of time, perhaps even through the entire life cycle of your investing journey.
They're better than bonds, right? Because bonds are super risky in real terms, as we've talked about at length. Whereas something like CPP is an inflation indexed annuity. It's not exposed to inflation risk at all whatsoever. It gives you an actually guaranteed income stream that's adjusted for inflation. So, like, that is the risk-free asset.
So then if an investor is trying to figure out where bonds, GICs, cash products and stuff might fit in their portfolio as a long-term investor, what do you think the headline considerations are that can help them make that determination?
Any short-term need, if you know you're going to buy a new vehicle in 12 months and you have the cash now, would I tell you to invest it in stocks because it has a better expected outcome? Probably not, because it would really suck if it dropped by 40% over the next year. So sticking that into a high interest savings account or into a GIC, that will tend to make a lot of sense. We do that for clients at PWL if they have known fixed expenses. Like, it could be a tax bill, it could be a major purchase that we've planned for. So I think that's a totally legitimate use of cash. Some people just like to hold cash. And I mean, who am I to tell them that that's wrong? I think it's all extremely personal. And even if we can quantify it, even if we can model it, as I talked about earlier, the model is going to be specific to its inputs. Like, there is no right answer to a lot of these questions.
Though, if I'm hearing everything correctly here, the key takeaway is reflexively jumping into things like bonds and GICs and cash and stuff like that, based on the historical data, at least probably isn't the right move in most cases.
Yeah. I mean, if we're talking about probability distributions instead of point estimate optimizations, I think we have better information there. And if we're talking about probability distributions based on history, yeah, cash and GICs they're pretty riskier. They're a lot riskier than people, I think, realize.
So I think, Ben, some people might be curious in the audience here. What do you do? What's your approach to grappling with this in your own portfolio?
So I'm in a 100% stock portfolio. I am pretty comfortable with financial markets. I've spent a lot of time researching the history of markets, the psychology of investors, financial theory. I spent a lot of time talking to other people about their money and observing them make financial decisions. I've thought a lot about what is the true worst case scenario. Like, is my portfolio of stocks going to go to zero if it's properly diversified? And my thinking on that is probably not. And barring that absolute worst case scenario, I think a diversified portfolio of stocks for a long-term investor is at least a pretty good bet. I like that probability to distribution. I'll put it that way. So for me personally, that's what I do. I do expect stocks to contribute more to meeting my long-term goals than holding bonds or cash would. And I'm pretty comfortable with my own ability to withstand market downturns. I mean, the reality for me is when a market downturn happens, I'm so busy talking to clients about them not selling their portfolios, I don't even have time to think about my own.
Yeah, that's fascinating stuff. Thanks for kind of giving us a peek behind the curtain in that fashion. And actually, just a note to the audience: Ben actually discussed his personal approach to investing in a past episode with us. It's called 5 Factors I Use to Build My Portfolio. You can check it out on TD's YouTube page as well as the Learning Center in Webbroker. It's a great watch. Check it out. I think at this point we've run a long gamut here. I think we have to leave it there for now. But thank you for filling us in on these hidden risks of bonds and GICs and cash that long-term investors might want to think of. Do you have any sort of final thoughts that you want to share with the audience?
I would reiterate what I said when we were wrapping up, that asset allocation is very personal. It's very important and it's very personal. So I do hope people who are listening will take the time to reflect on their situation, their goals, and that's a whole other rabbit hole we could go down, people's ability to reflect on what their goals are and actually identify accurately their financial goals. People don't tend to be very good at that. There are prompts that you can use. Anyway, we did some research on that a while ago. But I'm going down a rabbit hole that we don't need to go down in the last 30 seconds here. But I hope people will take time to reflect on their situation, on their goals, and make sure that their portfolio is set up in a way that matches with those.
All right, Ben, thanks again. We really appreciate you taking the time to join us. And to our audience as well, thank you for tuning in. Make sure that you register for upcoming episodes that we have of Inside Investing, and make sure you check out our past events in our library on YouTube, as well as in the Learning Center on Webbroker. Appreciate you tuning in, and we'll see you all next time. Have more questions? Then check out the links to the right and in the description below.